let's start with a very short presentation. So
I've actually got this.
Yeah.
Thank you.
It's a privilege of women. So Veronica, so I'm pleased you join us today because you are coming from IMMFA. You are CEO of IMMFA. But just a short introduction of who you are and maybe briefly IMMFA for those who do not know IMMFA yet.
Yes, certainly. And thank you very much for inviting me to join today, and good evening, everybody. For those of you who are not familiar with IMMFA, we're the trade association which is dedicated to representing the short-term money market fund industry in Europe. Our funds are predominantly domiciled either in Luxembourg or in Ireland. They are sold to a wide range of investors across Europe, including, of course, Luxembourg. And we really particularly appreciate this opportunity because corporate treasury investors represent consistently a third of our investor base. And also because obviously in these times of heightened uncertainty, cash investment and therefore money market funds have become an even more crucial asset class.
Okay, very good. Marc?
Hello, everyone. So I'm heading the liquidity solution sales team of BNP Paribas Asset Management. That means we are in charge of promoting any solution as long as it's short-term investment. And by short-term investment, we mean anything which is below 2 years. So I would say 80–90% of our business is promoting money market funds. The rest would be short-term bonds.
Jean-Philippe?
And Jean-Philippe Bernard, so I'm working for Deere Cash Management here in Lux. I'm leading the Treasury department here in IMMFA with a bit of APAC, so you know how Treasury can be. You had roles and hats. And mainly our challenges, what we do day to day is managing risk, reacting to uncertainties, trying to anticipate flows, and trying to find the right partners to be able to work through the uncertainties. That's, I would say, our day-to-day job.
Is it easier for a US company to sell internally money market funds? Because we mentioned earlier on the communication, education of the market, for, at least for European and continental Europe. Is it easier for US company, knowing that money market funds have also evolved and have been newly regulated? So
I think the main change, if I would say, American culture to European culture is you can ask your colleagues or known people in the US and you ask them to their 5-year-old child if they know about financial markets. And you would be impressed that the 5-year-old child know more about financial market in the US than your 18-year-old child in Europe. So I think the way the approach is made in the US is really towards investments, really towards financial markets. So having to convince a US C-level to go on money market funds, it's not a big deal, I would say. It depends of the conservativity of the company. The most challenging aspect is actually in Europe. And it's true that we have two different perspectives. And you need to adapt to the different culture you may have between let's say, people, which is especially true in Luxembourg. So all team is 18 nationalities, so you can imagine.
Fair point on education, because it's something that, and it's why they've renamed CMU SIU, because they would like to, we as, let's say, a retail side, to invest more in this kind of product. We will see what will come out. Maybe a question for you, Marc. So I see that you've had a look at the EACT survey, the question on short-term product usage. So any comment or any, let's say, reaction or remark on the results? So do we still have a long road to run before, let's say, promoting alternative and diversification products?
Yeah, so the survey was quite long, but I had a look. To me, there are two things which I think are worth being shared. The first one, which was mentioned already, is, interestingly, one of the key issue corporate treasurers are facing is how to forecast flows. So uncertainty on flows. And I think it was either first, second, or first over the past 3 years. So it's something that is consistent over time. What surprises me is, and I'm promoting money market funds, but what surprises me is, as an individual investor, when you don't know whether you'll need to pay something tomorrow or in a year's time, what do you usually do? You keep your cash liquid because you want to make sure you don't invest on something on which you will be locked. You don't invest, for example, as an individual investor, you won't invest in a life insurance policy on which you're locked 8 years. You'll want to keep everything liquid. As a corporate treasurer, I'm surprised, and it was back to one of the comments you made, how much, given that uncertainty on flows is still important, term deposits are still by far the key instruments they use. Because honestly, I mean, if you're talking about liquidity only, if you invest into a fund, you invest today, and you don't need to be bothered by your fund as long as you don't need it. You can stay invested 1 day if you need your cash tomorrow. You can stay invested 5 years if you don't need your cash before that. So, I mean, it's a fantastic instrument to use when you have a huge uncertainty on flows. And I'm surprised, and that's another comment which you can see on the survey, that why is it that corporates still use as their first instrument term deposits?
Yeah.
And I had a thought, and I think I finally found the solution to that. There is a huge difference between a term deposit and a money market fund. The term deposit is obviously sold by the bank. And when a corporate decides to deal with a bank, to have a banking relationship, it's really a very strong partnership. The bank provides loans, the bank manages cash, the bank provides plenty of services, but in order for the bank to be able to provide all that, the bank needs fuel. And what's the bank fuel? It's term deposits. The bank needs their balance sheet to be as sound as possible. So what's happening? The bank is dealing with a corporate, and they're asking the corporate to help them providing all the services they're providing. It's as simple as this. When you're entering into a banking relationship, it's a very strong move. A money market fund, you invest today, and if you're not happy, you redeem the following day. The only thing that costed was potentially the KYC. And that's a huge difference. That's why, for example, banks definitely want to promote term deposits. It's because it's a win-win situation for banks. I belong to a bank group, so I understand that. But then I'm also an asset manager, so I want to sell my money market funds. But I know the bank will predominantly want to provide a service on their term deposits. So how can you as a client, you as a corporate, use both services the best way, invest in term deposits to help the bank provide all the service, to help the bank fund its balance sheet, because the bank needs that. But then in terms of efficient instrument, honestly, money market funds are very, very, very efficient because of what has been said, diversification, liquidity, risk mitigation. They're great, but don't forget to sell the bank too.
Yeah, similarly, I'm also surprised. Last year we presented a platform like Treasury Spring, and the possibility to access easily to guaranteed deposits. So it's also something that I'm surprised corporates are not using more. Because if you want to go for a deposit with a bank, why not going for a guaranteed deposit? Also a possibility to mitigate your risk. And again, I totally agree with you. Diversification is quite important. The relationship is key. Up to a certain limit, the counterparty limit you fix with your counterparty. So I'm surprised that some our members have no limits. I don't know at John Deere if you have limits, but I guess when it comes to counterparty risk, we know that since 23 or spring 23 that it's a big risk to manage.
So obviously, we have limits, and we check them every month. So they are on scrutiny every day, and we reassess them every month
globally.
So that's a first point. But to go back to the relationship, what I like to do is to dissociate the relationship that you have with one partner and the leverage that you get from it, and it's totally two different aspects. So the relationship is what you negotiate with a bank, for example, or with money market funds, or how do you work with that party to make sure that it's a win-win solutions. The leverage is what it gives you as a return. And you should not pair them together. You should think them totally differently. And the reason why I'm saying this is because you may decide to have an investment which is not made for the yield. Sorry to say that, but we are Treasury. We don't necessarily compete for the yield. However, you may want to have these investments because in your balance sheet, it would help you to get a better rating. And this would actually impact down the line the way you are able to raise debt, your capacity to raise on the market. So sometimes the type of investment you will do is totally not related to the performance nor the relationship, just because you have another leverage that you need to get in place to make sure that you can continue your business. And I think that's where I fully align with Marc on this aspect. Is it's key to build the relationship, and we do that at Deere, meaning we negotiate, for example, the credit line with banks. BNP is one of them. In returns, we also go for some deposits, mainly in the US in that case. But somehow that's it.
Yeah, and as Patrick mentioned, so we should not forget IS7 because it's also a constraint, the cash and cash equivalent qualification that could have also an impact on credit rating. And of course, we are not looking for the best yield, but for what will be, let's say, best in terms of assessment of our credit solvency. Veronica, we mentioned, and Marc, we mentioned that again, so the recent event that had led to uncertainty and volatility in the market, how are money market funds navigating in such uncertainty and volatility? And maybe, I think that
Certainly.
I have a slide. Is it true?
Yes, that's perfect. Thank you, François. So, well, I'm pleased to say that as with previous and indeed much more severe stress events, money market funds have successfully navigated the most recent bout of volatility. After Liberation Day and the announcements of tariffs in early April, there was a wave of market volatility in the bonds and equities as investors obviously adjusted to expectations. But this had very muted impact on money market funds. In the onshore domestic US market, money market funds had modest inflows before experiencing their usual outflows following the mid-April tax payment date, which is totally usual. In Europe, we saw a similar pattern of initial dollar inflows, followed by limited outflows, which was then reversed, leaving assets broadly unchanged and, if anything, slightly higher. And as you can see from this slide, IMMFA assets under management year to date have been very stable with inflows in all three currencies.
Despite the current situation, yeah.
Yes, absolutely.
And Jean-Philippe, have you noticed among our members or colleagues or peers an evolution over the last months? We mentioned the financial crisis in 23 with a few bank default. More recently, the Liberation Days, etc. So have you seen changes among members or corporates in terms of the strategies, or are they quite consistent and sleeping on the existing policies and strategies? And maybe, Marc, if you can comment, because you are more in the market.
I would split the reply in two aspects. The first one related to the policies. Even though usually the way I define a treasury department is a startup within a corporation, to change the policies is like trying to change Bibles. It's
difficult,
to say the least.
Almost impossible.
So this is first a challenge. However, we can always let's say, play around it, still making it work and make sure that we are efficient. So this is the first aspect about the policies. It's really hard to change them. And just as FYI, the investment policies of John Deere has been set in place, the last one, in 2008. So, and we are working every year to get them.
Before or after the financial crisis?
After. So this is one aspect. The other aspect, when we speak about like different treasurers, and we see it more and more within our meetings at ATEL, and I think, Benjamin, you said it very well, is we are looking to technology. Why technology? Not because it's fancy, but because it helps you get the cash forecast, get the hands on the data, and being able to do something with it. What I was discussing with Sophie a bit earlier is there is no greater risk than a C-level which is not well informed and taking a wrong decision. And that's our duty, to have the right data, to have the right analysis, to give them those data so then they can take the right decisions.
Marc, any comment? You've seen change in, let's say, trends or strategies?
Yes. The thing is, corporate treasury teams are usually, and I might be wrong, but I think I'm not, are usually quite short on staff.
In general.
In general, and I think it's all over the place. They're usually very short on staff, which means they must prioritize what they're working on. And I've seen, so I've been in charge of the liquidity solutions team for 7 years now. We have seen on some interesting periods. We did see some changes from corporates, but it's because they had to change. Quoting a few of these changes. When yields turned negative, how the money market fund regulation works, there are some things which we were not allowed, us as asset managers, to provide anymore. For example, stable NAVs. We were not allowed to sell and provide stable NAVs on euros when yields were negative. That said, lots of corporates were still interested in money market funds, even though they were yielding negative. What did they do? They changed their policy and they invested in variable NAVs. That was a huge change. Another example, a change in regulation. Not everyone is probably impacted by that, but last year there has been an important change in the US regulation on what we call the institutional prime funds, which are the equivalent in Europe to the LVNAV funds, where basically what the regulation says is, if you're facing, you as an asset manager, lots of outflows, more than 5%, you're allowed to put, let's call it liquidity gates. So you're allowed to charge your clients. That's a new regulation that kicked in last year. What did US corporates? They changed their policy because, of course, they did not want to be in a situation where they wanted to redeem potentially just 100 million and being told by their asset manager, ooh, by the way, we're going to charge you 1%. Of course. So that was another example where they had to adapt because that was a regulatory constraint. And the last one to mention is back during the first wave of lockdown of COVID, so February 2020, huge market stress, a lack of liquidity of some instruments. What did we see? We did see corporates, I wouldn't say changing their treasury policy, but shifting from one treasury instrument, for example, standard money market funds, which are the riskier money market funds, to AAA-rated money market funds. They just wanted to lower their risks. And even though some of them had never invested in those AAA-rated money market funds, they were so terrorized by the fact that there was no market anymore. I mean, don't forget, first wave of COVID, lots of intermediaries, they couldn't even work because they didn't have remote ways of working from home. So then some of them did change their policy. So back to your question, we do see changes, but it's because treasurers need to implement them. What happened over the past weeks or months, they don't care about volatility on equity markets, on bond markets, spreads widening or not widening. It has no real impact on what money market funds are delivering. Or actually, it has a positive impact. The more spread, the more return we're delivering. And treasurers tend to rely on what we do, because that's the whole point about investing into a money market funds is you don't want to be bothered with managing this day-to-day cash. I'll just delegate that to someone whose work it is to do 100% full-time job, mitigating counterparty risk, volatility, liquidity, and those kind of things.
Yeah, the chart Veronica showed us proves that we are quite, let's say, regardless when it comes to volatility of the market. Maybe a final question for you, Veronica. We mentioned reform, and thanks for the transition, Marc. And we know that last year we were, let's say, strong enough together, all stakeholders, to push back this reform in Europe. But you mentioned the US reform. We know that also there is a project of reform in the UK. Could you just update us and what are the risks? Because, as you said, if we remove some categories or increase the threshold, etc., maybe it could be at the expense of the return, potentially the actors in the money market funds. So we would like to have competition and not concentration, and at the end of the day, less products. So what is the situation at the moment in the UK?
Yes, certainly. I mean, and maybe just to sort of recap on the US, because it slightly links into it, is, you know, the US and its reforms, and Marc mentioned one of them relating to the mandatory fee regime, but also the SEC has also implemented increased liquidity requirements as well. So 25% daily liquid assets and 50% weekly, which are very high, and also delinking. Now, delinking, maybe just very quickly to touch on, because it's important in the context of European regulation. This was one of, or the link in the regulation for stable NAV funds was one of the areas which was recognized as not having worked as intended by authorities generally, and that's the link between the liquidity requirements and the potential imposition of fees and gates. It was this very much that sort of led to some of the need for selling assets, for asset managers to really ensure that those weekly liquid assets were kept well above the 30%, rather than enabling the buffers to be used as they were intended in stress situations, you know, to the benefit and as required by shareholders. So that's just one point, and that was very positive, I think, in the US, because it's had also knock-on positive impact in Europe. So the UK authorities have proposed and consulted on a range of areas. They focused mainly on looking at quality and quantity of liquidity. So they've proposed delinking, which obviously we support. The use of liquidity management fees as well. So just a clearer position on that for investors, in the same way that in the EU, in the review of the UCITS and AFMD directives, they've actually incorporated, the Commission has incorporated that in its review, you know, for money market funds and also the broader fund spectrum. They've also very supported the retention of the LVNAV, subject to some additional measures to enhance its resilience, which we fully support. And they've also proposed significantly higher liquidity levels across all fund types. So a raise to 15% daily liquid assets and 50% weekly. And we've argued that, in particular, the proposed level for weekly liquid assets is higher than necessary, especially given that delinking will increase further resilience. In the EU, the European Commission, as we all know, published a constructive review, resulting in a very positive, report in 2023 on the effectiveness of the regulation. But since then, it has become increasingly clear, though, that there will be a further review of some form, either later this year or early next year. And we know also that there's still pressure from certain quarters to prohibit the LVNAV. That the LVNAV category could then be challenged. Now, a challenge to that would have very serious consequences for many investors, including some no doubt here today, and so hence the importance of ensuring the investor voice is heard. And as François alluded to, we've been working very closely together and collaborating, so with the support of ATEL and the EACT to really help to ensure that the utility and range of choice of money market funds, which is actually one of the real benefits of the regulation, the fact that there are 4 categories, they all serve different purposes and they're all important, but it's preserving that. Because the removal of the LVNAV would effectively be detrimental in limiting choice and also concentrating risk.